Yeah. So we are talking about the characteristics of perfect competition. Large number of sellers, large number of buyers. Each seller is a price taker. Products are homogeneous. Means you, if you make a product, others can make exactly the same product without any problem, and therefore the price of the products will also be the same. There is perfect information. Normally, we find that when you go to buy, you are not informed because you may know what is selling at this shop, but you do not know what is selling 10 blocks down or in another market or in another town, another city. But here, a seller, a buyer goes to a seller, he will know exactly at what price every seller is selling in the market. That is perfect information. And similarly, a seller will know what the buyers are buying at price everywhere. So that we call perfect information. This is, of course, an assumption. And as you know, it is very difficult to have something called perfect information. But we assume for the purpose of perfect competition that there is perfect information with the buyer and with the seller. It is possible in this market to easily enter the market or easily exit from the market, which means that if you want to go into any business, you find that this business is profitable and you want to join, you can easily join. If you want to leave the market, there is nobody stopping you. You can easily leave and you'll probably get all your money back because there are many others who are going to accept what you were using at the price, existing price. This means that if there is free exit and free entry, if people can go and come as they like, there will be no supernormal profit. That means the profit will be minimum because as soon as the profit increases, many will come and reduce that profit. That is why the free entry and exit is there, leading to lack of supernormal profit. Only normal profit will exist. In such a market scenario, as we have discussed earlier, the industry equilibrium, in the long run and in the short run, will look as given in the graphs below. As you can see, in the short run, the supply graph is also positively to the, and the demand in the short run is, of course, an inverse curve. And positive curve is therefore the supply curve. And obviously, the equilibrium will be where the two will meet. When it comes to long run, since the supply will only be at a price which is equal to the equilibrium. So at equilibrium, we will find that the supply will be existing only at equilibrium. And therefore, it will be a straight line. As you can see, that straight line will coincide with the equilibrium of the short run. In the short run, there will be some play. They will settle down at the equilibrium, and the total production will always hover around the point, and therefore it will be a straight line. Long run demand curve will always be same as the short run demand curve. There will be no change there. The equilibrium will also be at the same point. That will also not change. Now we try to understand two situations. Okay. Now, what if there is a price ceiling? Price ceiling is something which is given by the government. The government imposes a price ceiling. So if there is a price ceiling, where will it be? It will be, it can be below the equilibrium or above the equilibrium. If it is above the equilibrium, then the price ceiling will have no meaning, because people will sell at the equilibrium. The price will not go up to the point above the equilibrium. Therefore, price ceiling is imposed. It will be below the equilibrium. Then it will have some meaning. And what will happen? Let us see the first point PC on the graph, which is visible to you. This is the point PC, and we can see from this that it hits the supply curve at this point. And therefore, if we drop down, this is the amount of supply that it will be there. While when we look at the demand curve, it will hit the curve here, and this will be and therefore this amount here is going to be the shortage. This will happen when there is a price ceiling. Whenever there is a price ceiling, there will be a shortage in the market. Price ceiling exists for ration shops. If you go to the ration shops, you find that they are selling at a price lower than the market. The market is, of course, selling at the equilibrium price. So when they sell at a lower price, the ration shops are always in a shortage. And obviously, one way they overcome this is by fixing quota. They do not give you beyond the quota, because they know that this is the limit which has been set by the government, and therefore we cannot go beyond that limit. So whenever there is a price ceiling, we will have shortages. For example, another very common example is the minimum wages. So if there is a supply of labor and price of the labor, the government has set a minimum wage. Is it a price ceiling? You cannot sell below the minimum wages. Rather, you cannot procure labor below the minimum wages. So is it a price ceiling, or is it something else? Think and tell me, minimum wages, what is it? A price ceiling or not? We are talking about supply of labor and the price of labor. On the y-axis, you will have the labor which has to be procured, and on the x-axis, the
So may I?
yeah, please go ahead.
So it is not price ceiling, because when we say price ceiling, it is the maximum price. Rather, it is something called price floor. If I'm not
Mm-hmm.
wrong about the terminology, but whatever the terminology is, it means that
Yeah,
there is.
it is. In fact, it is on the slide. If you see PF, price floor is given.
Okay. So it is price floor only, which means the minimum price, which is set
Mm.
by the authorities or government. So
Mm.
in case of minimum wages, it is not price ceiling, it is price floor.
Very good. So we now get introduced to a new concept, which is price floor. Price floor will occur above the equilibrium to have any meaning. If it is below the equilibrium, then it will have no meaning, because you are definitely allowed to sell above that. And therefore, people will sell above that point easily at the equilibrium. It will sell only at the equilibrium. It will not. So price floor means you can go above, but you cannot go below. Now, what will that lead to? If we look at the price floor, which is above the equilibrium, there will be, it will hit the demand curve here. So demand will be less. And what will happen? The supply will be more. And this will be the gap between demand and supply. And there will be excess supply and low demand. Therefore, you see, because of the minimum wages, what actually happens is that we will have more laborers available, supply will be more, and we will have demand, that is the people who are firms employing those laborers will be less. And therefore, there will be this much of employment. Had it been left at the equilibrium, employment would have been reduced by this much. So by imposing a minimum wage, we are increasing unemployment by this much amount. That clear? Because it creates an excess in the market. So there will be excess of laborers in the market, which means that there will be unemployed people. So when we think of minimum wages, we have to understand this concept of price floor, and then we have to discuss it. So as economist, you will know that it is not easy to set the minimum wages, and it is a very difficult task. We need to set it also, because we cannot allow the people to work at a very, very low rate, which will probably cause problems for them. And therefore, we have to understand these two situations. There are, of course, many other examples. Taxation also will be there for price ceiling and for floor price, how it affects. And we will discuss some other case studies also at a later point of time. Okay, but these are the concepts, and I hope you have understood this concept of price ceiling and price floor. Obviously, both are normally set by the government. And when they are set, this is how it interferes with the equilibrium. We will now look at the output decision for a firm in perfect competition. When we look at perfect competition, how the firm is going to behave in this kind of decision is what we will see. So we have already seen the marginal output rule, MR is equal to MC. This will hold true. Now, for your information and to make it easy, let me tell you that this will be true for all market conditions. The shutdown rule, that is, if the price is less than the minimum average cost, then you have to shut down the industry. This holds true for perfect competition. We will see how far it holds true for others, but there will be some differences also, which we will discuss. And the biggest difference is when it comes to perfect competition, price will be same as marginal cost, which will be same as marginal revenue, which will be same as average revenue also. So PC is equal to MC is equal to MR is equal to AR. That will be the condition in which we will find the equilibrium point. So the price is, of course, dictated by the market. So they accept the price. Average revenue will be same. And of course, because we know that the optimal decision happens at MC is equal to MR. Therefore, they all become same. We of course have the average cost, which will be U-shaped, and the marginal cost, which cuts the average cost from below at equilibrium. At equilibrium, we'll have MC is equal to AC is equal to MR is equal to MC at equilibrium. But at the point P is equal to AR, average revenue, and of course, that will be equal to the MR also. They will, all three will be same in perfect computation. This question is often asked, and this is a very important concept, that in which market condition all three are equal. And you will have to remember that will be perfect computation. That is where they all three are equal. Now, what do we use these competitive models for? Number one is the tax burden assessment, which means how much tax I can impose safely is used through these models. Now, you may have studied the incident ray and the reflected ray in physics. The same word is used here for taxation. Incidence of a tax, which means where the tax falls. For example, direct tax, indirect tax. Where does the direct tax falls in incidence of tax? Indirect tax is on the person who is responsible for paying that tax. However, incidence of tax for indirect is on a middleman, that is the seller. He is not responsible for paying. The buyers are responsible for paying because they pay the tax, and the seller collects on behalf of the buyers and passes it on to the government. That is why we call it indirect tax. So the incidence of tax is not on the buyer, it is on the seller. The buyer is giving the tax. In case of direct tax, where we have income tax and other taxes, it is directly on the buyer and they have to pay the tax as well. Now, economic incidence of tax is inversely related to price elasticity of demand for consumer and price elasticity of supply for the seller. For example, what this means is very supposing a tax is imposed on a product. Let us say apples. Apples were being sold at 100 rupees. Okay. We will consider only apples. We know that the price elasticity of apple can only be one. But we will assume, for purpose of understanding, that there will be two price elasticity of demand, one where it will be less elastic and one where it will be more elastic. So if the price of apple is more elastic, let us assume this first, which is, of course, it normally is, because people can go without buying apples, they can buy other fruits. So if that is the case, it is more elastic, and you impose tax, let us say 20%, which means the price rises from 200 rupees to 240 rupees. What will happen to the demand? The demand is going to decrease more because elasticity is more, so the decrease will be more. We know that with elasticity, the quantum of elasticity is more, the difference will be more. So a lot of people who are buying apples now will buy some other fruits. They will not buy apples. And of course, हाँ सर, क्लास में है, थोड़ी देर के बाद करूं। हरे कृष्ण। So when we look at the apples, if we increase tax, we will find a lot of people not buying it. And therefore, what will happen to the revenue of tax collection? The revenue of tax collection, instead of increasing, will decrease, because you may be collecting a higher tax, but now you'll be collecting from lesser number of people. Clear? Therefore, it has got no meaning to impose tax in such a scenario. Now, let us look at the other scenario when this apple is inelastic in nature. So, what will happen? You impose a 20% tax, price goes up from 200 to 240, but because the nature is inelastic, therefore, what will happen? People will keep buying the apple because they have no alternative. It is inelastic. They have to buy it. And if they buy it, the revenue will increase in such a scenario. So if it is less elastic, it is advisable to tax. If it is more elastic, it is not advisable to tax because the revenue will decrease. Let it be as it is. In fact, if we look at some real life scenarios, we'll see, for example, cigarettes is something which is constantly being taxed. Why? People cannot leave smoking. Those who smoke, of course, those who don't smoke will not start smoking, but those who smoke will keep smoking. And therefore, they keep on putting tax on that without worrying about what will happen to the revenue. The revenue will definitely increase because it has got an inelastic nature. Whether you put low tax or high tax, only the same amount of sales will take place. But for elastic products, we find that taxes are not changed too often, and it is not changed regularly up. Sometimes it is decreased down and up, depending on the politics. That's a different issue. But economically, it doesn't make sense to tax them, because if you tax them, you are going to actually reduce the revenue. And therefore, taxation should occur on items which are inelastic in nature. There is another aspect to it, and we will discuss this now. Now, we take the example of apples only. The seller is in a position to know the tax first. So he is aware that if the government increases the tax by 20%, and if I increase the price by 20%, my 50 buyers are going to go away from me. And I will be at a loss because he will also be at a loss. His revenue will also decrease. The amount of quantity he was selling earlier, and now that he's not sell much. So what will he do? He will think of how to retain maximum of the, and therefore he can think of absorbing that tax. So 40 rupees from his profit he will bear, he will pay the government the tax. And now he was making a profit of, let us say, 60 rupees. Now he'll be making a profit of 20 rupees. The buyers, for them, there is no change, and therefore they will happy and continue buying from that Apple person. Apple person's profit has gone down, but not as much down as it would have had all the buyers gone away from. Therefore, he will bear the burden of the sales. Now, if he knows that the number of sellers, buyers are not going to go away because the product is more, rather less elastic or more inelastic. So what will he do? He will tell them that this is the cost of taxation and you have to pay that. He knows that they cannot go anywhere. They have got to buy it. Therefore, he passes on the burden to the buyers. So when he passes on the burden to the buyers, he doesn't have to bear. Now, whether he will be able to pass on the burden of the tax to the buyer or not is also directly related with the elasticity. And there is a formula for this. The consumer's burden of tax divided by the seller's burden of tax equal to the price elasticity of supply divided by the price elasticity of demand. So as we have seen from the example, this is definitely going to be true. The burden of taxation will depend on whether it is elastic or not, whether it is possible for the seller to pass on the burden of the tax without making the necessary changes in supply quantity. Because if the supply quantity effect is affected, the seller is going to lose revenue, which of course he will not like to do. He will like to retain the revenue. This is the normative analysis of perfect competition, which we have seen. The total surplus is maximum at equilibrium. So when it comes to this, we have already discussed earlier. Therefore, we will not go into great details. We are talking now here about the concepts of total surplus comes from which concepts? Concept which we have already studied earlier in detail. Consumer surplus and producer surplus. Okay. So what is A? It is a producer surplus and B is the consumer surplus, and then we have the total surplus will be maximum in perfect competition. Now I move on to monopoly. Here a single firm faces the entire demand. One firm and is exposed to the entire demand. Since this is an imperfect market condition, earlier it was a perfect market condition. Now we are discussing imperfect market condition, first type monopoly. So we will not be price takers, we will be price finders. We will try to find the price according to the market demand. Market demand is beyond the capacity of the firm. So market will give a demand and it will start trying to find that from that the price. In monopoly, since there is only one firm, there is no role for strategy. The strategy is about competitive. Competitiveness can come only if there is more than one firm. Who do you compete with? There is no competitors. There is no competitor, there will be no role for strategy. There are no substitute products also because nobody else is there producing the product. You are the only one making the product. So there is no substitute product also. Entry is not allowed. So there will be no entries. Nobody else can come and enter the market, which means what will happen to the profits? You can have supernormal profit. Now, I ask a question to the class and let us see who is able to answer this. Can a monopolist set his own price? He can decide that I'm going to sell at 700, 500 or 10,000. Can he do it?
Yes, sir.
Sir,
Very well.
He can do it.
yes, Yes, sir, the monopolist can do, because he is the one who is controlling that particular market. Like if we take the example of railways in
Anybody who
India.
disagrees, okay, I've understood you. Anybody who disagrees,
Sir, I would
So I
like to,
dis
sir, I would like,
okay,
sir, I
Sir,
would
one
I
by
like
one.
disagree.
to check, sir.
Okay, tell me, why do you
Actually,
disagree?
sir, so because in telecom industry we have some of the organization like regulatory organization like TRA. So they set certain criteria or the certain
No,
methods
that is
only
a
through only
concept
through
of
that
price
level.
ceiling and floor ceiling. That is a concept of price and floor ceiling that a part in monopoly. As a monopoly, you have to give an example of a monopoly. Telecom industry is not a monopoly. So in a monopoly, will it be possible for a firm to
Sir,
set
any
its
industry.
own price? Not
so
any industry, monopoly industry.
Yes,
so
sir. Monopoly
monopolies
industry
are
can
mostly
form.
followed by the public sector, the government owned facilities, and so they do not fix a price that is above a limit. Like the trains, they have a very cost that is minimal for the normal people. Also, we don't see monopoly in the private sector as such.
Okay, so imagine a
So,
monopoly like
your
situation. Do you think you can set your own price?
So if that thing is, if the thing has in elasticity and the demand has to be fulfilled, then it can set. But if the things can be done without it, they cannot set a price.
There's no question of elasticity here. There's no question of elasticity here. Can they set can they set their own price? If no, why? If yes, of course, many people have said yes. I want to know
sir,
why.
sir, I wanna answer.
Yeah, go ahead.
Sir, to set a price for a product or for anything, we need to check many more things, such as in elasticity, market demand.
Forget elasticity. Market demand. This is the answer I wanted. That is the correct answer. He cannot set his own price. He has to go by the demand curve. I have already written this in the first line itself. Please look at and read it and understand it. It faces the entire demand curve, means it has got to supply to the market. Now, if supposing you have a monopoly product and there is no demand, you cannot make the product because there will be no buyers. I'm just giving you this as a hypothetical thing, but if there is a slight demand, you can meet the demand. Now, if you set a price, where will you will have to, as it is written in the first line itself, you become a price finder and you find the price on the demand line. Obviously, you price it where there is slightly less so that you make some profit and you try to maximize your profit. We will see this in further in detail. So when we look at the price
Sir,
output decision of a monopolist, yeah, go ahead.
yes, sir. When you talk that it will depend on market demand, but sir, in a monopoly market,
Yes,
that particular organization or that particular firm is the only firm which is making that particular product. So
right.
why will it look for the demand? Like it will have an assumption.
It will, listen, it is, supposing you make a product, Apple. The Apple will have a demand curve, yes or no? This fact is beyond the capacity of the firm. What is the demand? It cannot
Sorry,
change
sir.
the demand curve. Yeah,
Sir, someone just removed me from the meeting. Can you please tell again what you said?
yeah. How these things are happening?
So
Anyway,
I don't know. I was also removed just थोड़ी देर पहले एक बार फिर से हटा दिया था मुझे.
very strange. There will
So I
always be
so I want to
troublemakers.
so I want
I'll,
to
yeah,
I want to say something, sir. Sir, make everyone attendee, so that no one can remove anyone.
If I make everyone attendee, there is one problem. You will not be able to ask questions like you are doing now. I can do that. If I make you attendee, it will not be an interactive class. It will be more of a monologue which I have got to carry on.
So
I have no issues with that. Perhaps
so
you
Sorry
are
to
it will
interrupt,
be
happy with
sir.
it.
Sorry to interrupt, but we can ask question as an attendee. We can unmute ourselves by our
so
end
you
and
can
we can ask questions. In other classes, we do the same thing.
Okay, okay.
it is
I
just that
had the
we cannot
concept
share
that,
the screens.
okay. In that case, I will make everybody attendee from the next class onwards.
Sure, sir.
Absolutely fine.
Sure, sir.
And then we can get rid of these pranksters.
Yes, sir.
Yeah. I was not aware of this, that you can interrupt and ask questions. If that is possible, nobody else needs to share the screen. That only I need to do. So absolutely fine. I'll do that from the next class onwards, because this is not tolerable. And I'll of course be passing on the recordings to the Microsoft team. And if they are able to identify who has removed, they will be penalized very badly. Coming down to the downward sloping demand curve. Okay, that is something which will exist in the market. So that will
So,
be your. Go ahead.
sir, in monopoly market, the firm would be the price. The firm would not be the price maker.
It will be the price in monopoly. It will be the price finder. It doesn't make the price. It finds the price in imperfect market condition. You try to find the price,
So, sir, even if the firm is
and
deciding
it is you take the. There are two concepts: taking the price and finding the price. There is no concept of making the price. For example, you decide that my product is going to sell at 10,000 rupees. You have made a mobile phone and you're going to sell it at 10,000. When it goes to the market, nobody buys it. So what do? You change the price to 8,000 rupees. And then you find that there are many buyers for 8,000 rupees. So you have tried to find the price. You found that 8,000 sells, 10,000 doesn't sell. So you have an array of prices there, a range of prices. And the price at which it sells is the price which you accept, where you make maximum, where you supply. If you find that at a higher price also there are some buyers, then you make a quality product at a higher price and you try to sell them. Okay? So you are trying to find the price.
okay.
Okay?
Thank you, sir.
So this is understand the terminology and read the terminology and use it. Don't ever write that you are price giver. You actually are a price finder. Obviously, in trying to find the price, you will give several prices. Why one? 1, 2, 3, you will give several prices to the market. You find this is the price at which it sells, and that is the one which you will. So when we look at the price output decision of a monopolist, it's a downward sloping demand, or the AR curve and the demand curve is the same, average revenue, and there will be a falling marginal revenue curve, which will be below the AR curve. It will be having the same, but it will happen earlier than the average revenue. And marginal cost will be a U-shaped curve, and it will cut the MR curve at E. So at the point E, MR will be equal to MC, and we know that the maximum output occurs at MR is equal to MC. So if we draw a line from E and it falls on the x-axis, what are we going to have? The supply, how much a monopolist should make to make the maximum profit. And if we extend the line and it hits the demand curve, then we will find the price. at Y. That is the price at which he should sell to make the maximum quantity sell. So his sales quantity would be maximum at this point P on the Y axis. However, if he sells at this point, he makes the maximum supply. And this is the price he gets. But is that what he is going to do? Because then what will happen to the profit? It will be normal profit. So what he does is he supplies less, slightly less than what is equilibrium, which will increase his price, and still he will be able to sell this much quantity. And he will make supernormal profit. Since he is alone, people will have no alternative but to buy or not to buy. This is what they will do. So he will lose a little bit here and he will increase the revenue here. This is what he does. And this is what happens and this is what is written here. So the output is lower, the price is higher in a monopoly than in competition. This is because MR is same as price in competition and MR is less than price in monopoly. So marginal revenue will be less than price. So this is a change now. Earlier we had said that for a competitive scenario, marginal revenue was equal to price. Now in monopoly, marginal revenue is less than price. The price is going to be less than the marginal revenue. And in competition, MR is equal to MC is equal to P. Here, it will be equal to MR is equal to MC and MR will be less than P. So price will be higher because he wants to make more profit. Any monopolist will try to make more profit. Of course, he cannot go beyond a certain limit. Slightly he can increase the price and therefore it is price is greater than the marginal revenue. Okay. So is this clear?
Yes, sir. Thank you, sir.
Fine. Fine. Now we tax our monopolists. A monopolist may or may not be able to pass the burden of the tax to the buyer. Because, as we have already said, it depends on the elasticity. It doesn't have got to do anything with the market type and elasticity of the product. So only if it is inelastic, the burden can be transferred to the buyer. If it is elastic, monopolist will also have to absorb the tax if he wants to supply as much and not want to decrease his revenue drastically. So monopolists can also be safely taxed by the government without any issues, because it has nothing to do with they will have to in fact look at the product type rather than the type of market. So we'll stop here and we'll continue from normative analysis of monopoly in the next class. We'll discuss the deadweight loss also, which is an important concept and questions of which are asked. If anybody has any questions so far, you can ask. Otherwise, we'll discuss in the next class.
Yes, sir. So I just want to ask that in today's class we
Yes.
got a formula: consumers' burden divided by sellers' burden is equals to price elasticity of supply divided by price elasticity of demand. So I mean, why we will use this formula and this is for what? I just fail to understand.
Yes. Yeah. This is for the purpose of decision making on the part of seller, whether to absorb the tax or pass the tax on to the buyer. He has got to decide, no? As a seller, the government has put the tax. Fine. Now, the loss is going to be sellers. Government is not going to come and give him the profit. Has to give him the profit, right? So he has to worry about himself. And when he is worrying about himself, he has to seek a way out how to take the right decision. Should I pass on the tax to the buyer or not? For this, he will need this formula.
Okay.
The buyer, of course, is a mute spectator here. He will only be worried about the price. If the price goes drastically up, he will not buy the product because it is elastic in nature. If it is inelastic, he has no option. Even if the price goes high, he has got to buy it. You get the point. So this is, and we are dealing with the firms. So firm is the, so this is a decision making on the part of the firm. Managerial economics is about that. Therefore, the formula. Is it clear?
Yes, sir. Yes, sir. Thank you so much.
Fine, fine. Any other questions? Okay, so we'll